Hello everybody. Today I am going to be walking you through Module 9, Intercorporate Entities. And if I can get my computer to cooperate, there we go. I can maximize this. And okay, the first learning objective from Module 9 is to examine and interpret marketable securities reporting. And marketable securities are those stocks and bonds owned by an individual company, and the reporting for those, they'll show up on the balance sheet. But as you can imagine, when you own stocks and bonds, the value of those has a tendency to fluctuate, sometimes wildly. So there are some rules that we need to be aware of and follow when we report those financial sheets, and also analyze when we have companies that have large stakes in marketable securities. Firstly, we're going to talk about intercorporate entities, and we've talked about this in the past. This has shown up on our financial statements before as a minority interest when one company owns a stake in another company, either partially or majority owned. Then we will show that interest as a minority stake on the income statements. It's the percentage of income due to minority stockholders, and on the balance sheet, it's the minority interest in the total assets and liabilities of the firm. So you can see the little graphic down there at the bottom. It talks about the level of control. If the company has control, and typically think about that as 51%, but it doesn't have to be. If you have a company that has its equity divided into voting and non-voting shares, it can be 51% of the voting shares, which gives them control, but that may not represent 51% of the economic interest or really anything close. So you have to be on the lookout for these little wrinkles, but for the purposes of today's conversation, let's just call control 51% and no control less than 50%. So you can see there on the right-hand side the accounting methodologies we're going to be looking at today. With no control, that's divided into little or no influence, in which case we're going to use the fair value method, and I'll walk you through an example of that. Or significant influence, in which case we're going to use the equity method, and I'll walk you through an example of that. And then lastly, if I just blanked out. If a company has control, then we would use the consolidated accounting. So let's look at some of the rules behind the level of influence. Little or no influence, we're going to use passive investments where the investor typically has less than 20. You might just circle less than 20 there. Significant influence is typically designed as between 20 and 50% of the outstanding voting shares, and then like I mentioned, control is typically 51, but doesn't have to be. So for passive investments, meaning less than 20% ownership or no significant influence, these marketable securities are bought and sold on a public exchange, and we're going to record those on the balance sheet at fair value. That is the purchase price. And then when the investments are sold, any gain and loss we're going to record as a gain or loss on sale of investments. Okay, so that part is simple enough. Let's look at the accounting for something like this. So in this example, we have the initial purchase of, looks like we're buying Juniper common stock for $20 per share. And we're paying cash. So we've identified the cash component of our transaction. The cash component amounts to $20,000 going out the door, so that's our credit. And we get marketable securities in exchange for that, so we have a $20,000 debit to marketable securities. Simple enough. Fast forward to the second transaction there at the bottom of the page. We now are selling 400 shares of Juniper common stock for $23 per share. Okay, so at $23 per share times 400 is $9,200 in cash. coming into the firm. That's a $9,200 debit. The 400 shares of Juniper are currently on our books at looks like $20 in cash. So we're going to credit $8,000 worth of marketable securities, and the difference is going to show up as a gain on sale, which will flow through the income statement to the balance sheet and increase our retained earnings number. So on this next slide here, I had made a note to myself to just circle that second bullet point in green there that says changes in fair value of the investment during the accounting period are reported in earnings. So changes in fair value of the investment during the accounting period are reported in earnings. And then the sub-bullet point underneath there denotes that this is a relatively new accounting treatment that is effective in 2018. So it used to be that interim fluctuations in the price of a stock that we might have held that's publicly traded would have been excluded from earnings on account of that volatility being determined to have, it can have a pretty outsized effect on earnings. But that's changing, and now we're going to record those differences in our earnings calculations. Okay, let's look at some of the definitions of fair value. Depending on what type of security we buy, whether or not it's equity, or maybe it's a private equity, or maybe it's a little bit more of an illiquid security, we have three different thresholds that we call level 1, level 2, and level 3. Level 1 are equities, so Microsoft, Cisco, Ford, General Motors, Boeing, big publicly traded securities that have a clearly quoted price. We know what they're worth, that we know what they're worth on any given day because we can look up the price. Level 2 might be a little bit less liquid, so those are quoted market prices in active markets for similar securities. You might think of like a private equity market here. And then lastly, level 3 have no liquidity whatsoever. So we don't have any observable inputs to guide us on what a security like that may or may not be worth. We might not ever know until we actually go to sell it and are recruiting buyers in the marketplace. So let's look at a fair value adjustment. In this example, we're assuming that Alphabet's investment in Juniper Networks, which was purchased for $20 per share in the last slide, increases to $25 per share at year end. So we're not selling it in this example, it just increases. The investment account must be adjusted to fair value to reflect the $3,000 unrealized gain, and that's important. We haven't realized it yet, it's an unrealized gain. So to do that, we would have the transaction at the bottom of the screen there, whereby Juniper increases by $5 per share. Our marketable securities increases by $3,000. So what we had formerly recorded, I think, at $20,000, we're going to add $3,000 to it, and now the balance would be $23,000. We're going to record an unrealized gain in the amount of $3,000, which will flow through net income and increase retained earnings. And that's an unrealized net gain. At some future date, we'll sell that, and that unrealized gain may become a realized gain. So you'll see this because, as I mentioned, this accounting begins in 2018, so we need to be familiar with how you'll see it recorded on your 2017 and 2016 financial statements. So it used to be that these securities were categorized by trading and available for sale securities. And trading securities were reported at fair value, but available for sale securities were not reported at fair value. Those were typically ran through accumulated other comprehensive income. The changes in the fair value of those securities would not be reported on the income statement. It would be recorded in accumulated other comprehensive income, which we've talked about in the past already this semester, That's the category of income that's reported below net income, oftentimes on its own separately reported statement. And there again, for the eagle-eyed analyst, it was always there to be analyzed. You just had to know where to go to look for it. Okay. So here's an illustration under the previous accounting, and you'll see this looking at 16 and 17 financials. In this example, that same $3,000 gain would have been recorded to marketable securities, but the offsetting credit would have been a $3,000 credit to accumulated other comprehensive income. In the current 2018 rules, we just credit that directly to unrealized gain on marketable securities. Okay, let's take a look at slide 12 here. Check my notes, see what we're talking about. Okay, non-marketable equity securities. So this would be that level 3 classification that I mentioned just a moment ago, and perhaps level 2, depending on how readily available the quotes are. You'll note here that these are privately held companies, and this similarly introduces the estimates into the equation, and new opportunities for financial shenanigans and gamesmanship and manipulation. So just be on the lookout for that anytime you see these securities being valued off of less liquid quotes. Okay, financial statements, disclosures. In your 10K filing, you're going to see something that looks a lot like this table. This is Alphabet's disclosed for 2015, where they clearly detail all of their marketable securities, cash, level 1, so you have money market, U.S. government, marketable equity securities, and then level 2. So these are maybe a little bit less liquid, maybe the market for these is not quite as clear, but most of them generally trade frequently enough for us to gain a level of assurance around what they're worth. So look for that in your target company, your research company, and try to pay attention to just how much value there might be embedded in those level 1 and level 2 marketable securities, and to what degree it fluctuates over time. Okay, so investments in debt securities are similar, only we do maintain the classification of trading securities, available for sale securities, and held to maturity securities. You'll see there that trading securities, we have the change in fair value reflected in current income, just like we talked about with equity securities. Available for sale securities are, we will put those fluctuations in available and accumulated other comprehensive income. And then lastly, held to maturity securities are those that have been deemed to, well, just like the name suggests, they have been deemed to be held to maturity. Management has committed to that, and therefore we're not going to record any fluctuation in their price until they're sold. Now this does, as you can imagine, introduce some opportunity for estimate and error, as management has the ability to transfer securities from one classification to the next and thus change their accounting. And when the accounting treatment changes, we have dollars flowing through to accumulated other comprehensive income, or maybe even current income. So be on the lookout for that. Held to maturity debt securities, this is the only one we haven't talked about yet. This is the cost method. We book those day one at the price we pay for them, and then we don't adjust that until we sell it. So we will have recorded that at the amortized cost, which I believe we talked about in Module 5, if memory serves. Okay, so let's analyze and interpret equity method investments. Equity method with significant influence. So this is not majority owned. This is between 20 and 50%. And here's our guidelines. Significant influence equals the equity method of accounting. And oftentimes you see this as prelude to acquisitions or a strategic alliance or pursuit of research and development. It can take a number of different forms, but what you need to remember about this is that it is between 20 and 50%, and that we're going to use the equity method of accounting. And let's look at an example of that. So here's a few other reasons why a company might pursue this: gain a seat on the board, controls technical know-how or patents, legal contracts. Any of these can, deem a partnership to be significant, and you could also make the argument that the equity method of accounting could be used for companies that have less than 20% if any one of these arrangements apply. And when we use the equity method of accounting, we're going to record the investment as a single line item. So if we pay $1 million for that particular equity, then we're going to have a debit to that security, company ABC, and then we're going to have a credit to cash in the amount of what we paid. Now, when we book that equity on our balance sheet, we're going to adjust it for any dividends that we pay. We're going to credit that investment for any dividends that we pay, and we're going to debit that investment for any income that it generates. So you can see here on slide 20, that's delineated as, investments are recorded at their purchase cost. Dividends received are treated as a recovery of the investment and thus reduce the investment balance. It's a little counterintuitive. I know students have struggled with that a little bit before. And conversely, the investor reports income equal to its percentage share of the investee's reported income. So if we own 20% of a company and we're using the equity method of accounting, and that company reports $100 million in net income, we are going to report our percentage share of that. So call it $20 million that we would report on our income statement. And why that's a little bit counterintuitive is because we don't receive that cash. But if the company were to pay out dividends, then we would have cash coming in the door. The equity method of accounting treats that as a return of capital and thereby decreases the value of the investment as recorded on our balance sheet. And then lastly, changes in fair value do not affect the investment's carrying value. Okay, let's look at an example. Examples always kind of help put a finer point on it. So in this one, let's assume that Google acquires a 30% interest in Mattel Networks. Mattel's balance sheet reports $1,000 of stockholders' equity, and Google purchases a 30% stake for $300, giving it the ability to exert significant influence over Mattel. So that's the key point there. We have 30%, which is between the 20 and 50% range, so we're going to use the equity method of accounting. At the first year end, Mattel reports profits of $100 and pays $20 in cash dividends to its shareholders, which would mean $6 to Google based on their 30% stake. So in this example, let's look at the initial transaction there, the purchase of 30% investment in Mattel for $300 in cash. So we know we have a $300 in cash going out the door, so that's going to be our debit, our credit. And our offsetting debit is going to be a $300 investment in Mattel. That first transaction is pretty straightforward. Move on to the second one there. Mattel reports $100 worth of income, and Google's share is $30. So we're going to increase our investment in Mattel for our share of that income. So you see the investment in Mattel is debited in the amount of $30, and then the offsetting credit is going to be equity income, which flows through our income statement and increases the value of retained earnings. Now let's look at the dividend in step number 3. Mattel pays a $20 cash dividend, which equates to $6 based on Google's equity stake. So we have $6 in cash coming into the firm. That's going to be our debit. Then our offsetting credit is going to be a direct decrease to the investment account. And you can see there that that's The investment in Mattel is being credited in the amount of $6. And then finally there you can see the ending balance of Google's investment represents all of those transactions, and that would show up on our balance sheet in the amount of 324. Okay, so on this chart here you can see how the income statement and the balance sheet are both reflecting the transactions that we just walked through. Our equity investment in Mattel is 324. You can see Mattel's income statement and Mattel's balance sheet. Mattel's balance sheet shows a total equity value of 1,080 after all of those transactions were booked at the subsidiary level, meaning that Mattel owned 100% of those earnings, which was 1,000, and 100% of those dividends. Those foot to a total equity value of 1,080, and based on the equity method of accounting, 30% of that equals the balance on Google's books. So it ties out both at the parent level and at the subsidiary level when we use that equity method of accounting. So let's look at some typical circumstances here. If the purchase price is greater than the book value, meaning that a company has equity value on their books. If I go back up a slide here. Right here, Mattel had equity value of 1,080. So in this next example, let's assume that Google buys a 30% share in Mattel for something greater than 1,080. Let's say they pay $2,000 for a 30% interest in Mattel. Well, what's that look like for Google, and what's that look like for Mattel? So in this example, if Google were to pay $400 for its 30% stake in Mattel, they would initially report the purchase price as follows. The $400 would consist of two parts: the $300 equity investment and then the additional $100 investment. So Google's management now has to decide how to allocate the excess of amount paid over book. So they can go through and they can look at the individual assets on Mattel's book, and they can mark them up, and they can say, well, Mattel's book value wasn't reflective of the value of the assets that we purchased a stake in, or they can just attribute it to goodwill. And goodwill is a enterprise value of the firm that has accrued to a business that's separate and apart from the individual assets on its books. So think about Coca-Cola. That would be the embedded brand power that Coca-Cola has built up over 100 years or more of selling sugar water into the marketplace. That company now has a value much, much, much greater than anything that would be represented just by the value of the assets on its books. You could go out and buy all the equipment to compete with Coca-Cola, and you wouldn't have a business nearly as valuable as Coca-Cola, even though you had identical assets. Okay, let's look at some issues that you need to be aware of when we use the equity method of accounting. There can be a substantial difference between book value and fair value, just like that Coca-Cola example I just mentioned. And this is really where the opportunity comes in for a good equity analyst. When you see a substantial difference between book value and fair value, that might be indicative of an opportunity for a sharp-minded equity analyst, especially if assets have appreciated and the balance sheet doesn't currently reflect that appreciation. That can indicate opportunity there. And then let's see, if the fair value of the investment has permanently declined, the investment is deemed impaired and written down to that lower fair value. So it's common to see assets appreciate and that appreciation not be reflected by a mark-to-market adjustment, but it's less common to see assets depreciate and have that go unrecognized, because that's more scrutinized by FASB, and there there are rules to record that impairment. Okay, and then we covered all the points on the bottom of that slide there, so let's move on to the underlying financial components. So in this example, we're going to take a look at the investment in SAB Miller on Altria's balance sheet in 2015, which showed up as exactly that, an investment in SAB Miller. When you zoom in, you can see that that investment was a partial ownership in total assets recorded on SAB Miller's books of $42 billion, liabilities of $20 billion, and liabilities and equities of $42 billion. So just another example of how that might be recorded. And there again, look in the footnotes and you'll get a full description on how that might be reported for your target company. Now this is star this slide, circle it, come back to it. It's a little bit technical in nature, but very likely to show up on the exam, especially in multiple choice format, because it's going to test your understanding of how some of the key profit margin, asset turnover, and financial leverage ratios are affected when we consolidate some of these subsidiaries under the equity method of accounting and later under the consolidated method of accounting. So it's your job to determine if these distortions are material and then to make any necessary adjustments. So you can see here how some of those distortions might factor into some of the accounting. If you look at net operating profit margin, for example, first on the list here, most analysts are going to include equity income in NOPAT because it relates to operating earnings, and that rationale is sound. But as you can see here in the second bullet point, if the investee's sales are not included in the net operating profit margin denominator, then net operating profit margin will be overstated because we have excluded those. So if it's significant, if the equity method of accounting is significant to your company, you need to think about tweaking that formula or making an adjustment. For most of us in this class, it's not going to be significant when we are crunching those numbers for our semester research project, but just be aware that it could be. And if it is, bring it to my attention and I'll help you make those adjustments. Same way with net operating asset turnover. If the sales aren't included, then that turnover is going to be effective, and same way with the leverage. So just star this slide, come back to it. It's likely to reassert itself in an exam format, and if it's material, then these ratios will similarly need to be adjusted on your semester research project. So return on equity in the equity method of accounting, similar here. ROE is unaffected by the equity method of accounting because the correct amount of investee net income and equity is included in the ROE number. So while some of these other metrics might be individually affected, the total ROE will not be. Okay, let's move on to explain consolidation and interpret consolidated reports. So remember that consolidation accounting applies when we have greater than 50% ownership and or control. So let's look at the primary determinant here again is control. I'm just moving pretty quickly over these points that we've already touched on. Some of these bullet points on slide number 30 would be good test questions, in particular the ones at the top of the screen that says control is exercised through economic power, and then the following items are consistent with economic power. So ask yourself, does the investor have the ability to influence decision maker? Does the investor influence financial results? Is the investor exposed to variable returns? Any one of those, if they apply to a holding that's even less than 50%, might indicate control. So in summary, consolidation accounting is going to require us to record 100% of the subsidiary's assets and 100% of the subsidiary's liabilities on our balance sheet. And this is when we will similarly report that minority interest that we've touched on in prior classes. This is how that minority interest comes about. Shows up on the balance sheet as the proportion of those consolidated assets and those consolidated liabilities that are actually owned by minority shareholders. So let's walk through an example here. Pardon me. Let's assume that Penman Company acquires 100% of the common stock of Nissim Company. The purchase price of $3,000 is equal to the book value of Nissim's stockholders' equity. During the next year, Nissim earned $400, bringing its retained earnings to $1,400. So on our balance sheet, we're going to record current assets, and you see here that in the second line, you see an investment in Nissim of $3,400. So we have, from left to right, we have the Penman Company financials, we have the Nissim Company financials, then we have the adjustments that we're going to need to make in order to arrive at our consolidated holdings. So as we move from top to bottom there, you see the investment in Nissim shows up on the consolidated balance sheet as a zero because we have added all of the current assets of both Penman and Nissim, and we've added all of the current liabilities in both Penman and Nissim to get down to a consolidated total liabilities and equities of $21,400. Now when you look at the income statement, you're going to consolidate all the sales, you're going to consolidate all the expenses, and then you'll have the net income at the very bottom of the sheet. Okay, let's look at I'm going to skip through this slide here and go to highlight a couple of, now this one is the consolidation of an 80% owned subsidiary. Now the last one was 100% owned, so we did not have the minority interest. But if we only own 80%, then there's still going to be 20% of that company owned by somebody else, owned by, in this example, what the authors are calling a non-controlling interest. You'll also see that reported as a minority interest. And in that case, you can see in the consolidated financial statements, we have added a non-controlling interest to the balance sheet and a net income attributable to non-controlling interest to the income statement, which amounts to the 20% of Nissim, in this case, that we don't own. If we've purchased these investments above book value, we looked at an example of this in the equity section just a moment ago. But what we didn't talk about is goodwill. So in this example, let's assume Penman acquires 100% of Nissim. Penman paid a premium to Nissim's $1,000 book value. The $1,000 premium relates to the additional value from corporate synergies, and in this case we're attributing that to goodwill, and you'd see the creation of a goodwill asset on Penman's books. And that's shown here on slide 37, where we have Penman, Nissim, and on the consolidated holdings we show goodwill, which doesn't show up on either of Penman or Nissim, but closes the gap between book value and what we paid for the company on the consolidated reportings. You know, other ways you might see that manifests are in the increase of intangible assets, or in any specific asset that we could identify as specifically worth more than what it showed in the book value of the acquired company, which might be, here the authors give us examples of marketing, customer, artistic, contract, technology, different assets that we might be able to attribute that greater value to, in which case we could mark any of those up. Okay, in this example, The authors are giving us the financials behind the purchase of Kraft. When Heinz acquired Kraft for $52 billion, the purchase price was allocated as follows. You can see that 29 billion of that was recorded as goodwill. And the authors break that down for us as between intangible assets with definite useful lives, which will be amortized over their useful life, and intangible assets considered to be indefinite, which will remain on the balance sheet at their fair value. So another little wrinkle that we talked about in module number 8, I believe, was translating foreign subsidiaries into US dollars, so consolidated foreign subsidiaries. When we do that, the change, the foreign currency translation adjustment is going to be posted to other accumulated comprehensive income. And you can see that disclosed here on Alphabet's disclosures. Alphabet shows total stockholders' equity in 15 of 103 billion and 120 billion, and accumulated other comprehensive income in the amounts of 27 million and 1.8 billion, which is broken out at the bottom of the screen here. And one of those components is the change in foreign currency translation adjustment at $1.6 billion. So that showed up as a loss. So that's substantial. We need to be aware of that. And like I mentioned the last time this came up in class, that can have some very outsized effects on the financials. So just be aware of whether or not that might be material for your the company that you're doing your research report on. So here we have another disclosure for other comprehensive income. You can see that this is that $1.9 billion gain or loss, and 15 is broken out. We have net income at the top of the statement there, and then we have other comprehensive income or loss. You can see how each of these line items is varying over time. Alphabet also has accumulated other comprehensive income that's associated with available for sale securities. We touched on that just a moment ago, and then also cash flow hedges. Okay, some issues in reporting subsidiary stock. Let me check my notes here and see if I really had any. I didn't really have any color to put on this slide, so I'm just going to move on. Reporting of sale of subsidiary companies. We've covered this already. I would just note that in the bottom there, that gain or loss on disposal of securities is going to show up underneath the discontinued operations, so be on the lookout for that. And then the limitations of consolidated reporting. So I would just draw your attention to several of the bullet points under this number 1 here. It says consolidated income or loss does not imply that the parent company has received any or all of the subsidiary's net income as cash. So it's quite possible for an individual subsidiary to experience cash flow problems even though the consolidated group has strong cash flows. So be on the lookout for that. Even though a subsidiary, maybe you're analyzing a subsidiary with a very strong parent, it doesn't mean that just because there's a strong parent, the subsidiary can't go bankrupt. Likewise, in this next bullet point here, unguaranteed debts of the subsidiary are not obligations of the consolidated group. So I think a lot of times investors see that there's a strong parent company associated with a particular debt issue or a particular equity offering, and that does not guarantee them any safety in that structure. Okay, so now we're moving on to the Appendix 9A, describe and interpret derivative disclosures. And I'm not going to spend any time on the appendix here. I'll let you kind of leaf through that on your own. Talks a little bit about the accounting for derivatives. What you need to know is that those are similarly reported in other accumulated comprehensive income. And there's a few slides on the differences between spin-offs, sell-offs, and equity carve-outs. And again, most of that is just terminology, so I'm not going to spend any time on it here. Review that on your own time. Let me know if you have any questions, and we will connect again next week in class. So thanks, everybody.